Good afternoon, everyone. And of course, right before I turn the camera on, I take a little swig of drink and I spill water all over myself. And so it's a great start. But thank you for taking a few moments with us today. We're going to get started. It's 4 o'clock. You know, I like to try to start as promptly as possible. So thank you for joining us. I plan to keep this somewhat relatively informal, maybe laid back a little bit. There's a lot of things happening, obviously, in both the world and the markets. And so I'd love to just share some thoughts. That's the purpose of today. You know me, I love charts and slides. I'll try to keep this as light and not try to go as maybe deep as some that may put people to sleep. But regardless, here we go. All right, so the purpose of today is really to discuss, has our view changed in any part since several months ago when we outlined our view for 2024? And so is the tide changing? Before we get started, I do, as always, want to say that anything you hear through this presentation today is for informational purposes only and educational purposes. Please don't act upon anything specific you may hear without either talking to us as your advisor, or if you use another advisor, please get specific advice relative to your situation first. All right, so let's start from the perspective of what was our view coming into 2024. So this slide was taken directly from that presentation we gave in January, and where this was our outlook. The first thing we said is we felt that interest rates will become lower, but then later in the year turn higher. We felt stocks would go higher and the bull market would continue. We felt that there wasn't a bubble in sight. Election year historical trends favor stocks. There was and is large amounts of cash on the sidelines, and that should help stock prices going up. And that there's an artificial intelligence super cycle underway. So I want to take some of these and dissect them a little bit relative to what we're seeing now, and has any of that changed? So how did it start? Well, the first quarter of 2024, things look great. The S&P 500 was up over 10.5%. The NASDAQ, which is obviously more tech heavy, was up 9.4%. The international indexes were up, and bonds were just kind of treading water. So early on, the first quarter, our outlook looked pretty good. Since then, and this is as of yesterday, not as of today, I know the market is lower again today, but April was not a great month. We're actually a little higher still probably from the lows of April, but ultimately, yeah, we've had some retracement this month due to several factors. So to put this in context, this is how we began the year, and this is what April is. So let's start with a reconditioning of how we view long-term market cycles. Some of you that have been with us a long time have probably seen a chart like this. I've used it multiple points in the past, but it really does reflect how history and how cycles tend to work. So this chart, it's a couple years old now, but really shows that there are periods of time where there is what we would call a secular bear market. So a very long period of time where the market just kind of goes sideways. And then periods of time where we have an expansionary cycle that is, say, 15, 18, 20 years or so, okay? And that pattern has repeated itself throughout history. And namely, there's reasons for each one of these cycles that I won't go into, whether it's the Industrial Revolution and such, but that tends to be the pattern. And our view is that if you look at the last most recent secular bear market essentially was from 2000 to somewhere around 2012 or 13. There was a very long period of time where it was a secular bear market. And our view is that somewhere around probably 2013 or so, we pierced through that cycle and began the next expansionary cycle. So I want you to understand that and look through that lens at everything else that we discuss today. So since 2013, here's what the market has done. A very significant advance over that, 11-year period. There's been bumps along the way, of course, and we remember a lot of those. But that is the evidence that we're in this expansionary cycle. Now, what happens is that most people throughout the early parts of that cycle don't believe you're in an expansionary cycle because you've just come out of such a long, prolonged period of time where markets are sideways. You've had fits and starts, so you don't tend to really believe it. But this is where we are today. Now let's look a little shorter term. So let's look from October of 2022, okay, which marked the end of the bear market in 2022 and the launch in the beginning of the most recent bull market cycle within this broader long-term secular cycle. And so this is what it's looked like, and you can see where we are now. Okay, we've had a retracement. The thing that there's a level of beauty, I think, in how markets work and when you chart them out over time, because you tend to see over time patterns, and they tend to be very symmetrical. It's really interesting. But this is, I mean, all we did is draw some kind of lines at the top and the bottom end, and you see that we're well within this pattern. So the takeaway from this shorter term bull market since October of 2022 is that we're still firmly in that pattern. And candidly, we have a long way to go downward before we were ever to think that, you know, a true tide is changing from the bull market perspective. Okay, again, keep that in mind as we go. But what if this bull market that began in October 22, maybe we are at the end? How does that stack up to history? Well, if the bull market that began October 22 ended, it would actually be the shortest bull market in history since World War II in the modern era. So could it be? Sure, anything's possible. I don't think it's likely. History shows that in a lot of context, but this is just one. I don't think we've seen the shortest bull market in history. But there's obviously some fear and some retracement that's gone on in the markets lately. And I think it's important to at least identify and consider what are those concerns, and should we pay attention maybe more notably than we are. Well, here's the main concerns, at least as I see them. The first is that inflation has been a little too sticky. So if you go back to our initial forecast for 2024, we felt that the Fed was going to start lowering interest rates by now, frankly. But they haven't, and they can't. The reason they haven't and they can't is because they have not seen inflation subside enough to where they feel that they can begin an interest rate cutting cycle, which essentially would stimulate the economy, not tighten the economy. So until we see inflation be a little less sticky, and that's one of the things about why the market was down again today, is there's some other inflationary data that's just suggesting that it's just a little stickier than we want it to be. Until we see that break, we're not going to get interest rates to go down. So that leads to the second one, is the interest rates are still too high. And the problem with that is, as we've discussed, high interest rates are a mechanism to slow down the economy. So there's this delicate balancing act that's going on between, we need high interest rates to slow down economic activity enough that inflation comes down, but we don't want to slow it down enough that we trigger recession and have a whole nother set of issues. The third is honestly geopolitical tensions and what's going on in the Middle East and around the world. So we're going to cover some of these and see how that fits into our narrative for 2024. So inflation's too sticky. Well, here's the bottom line. I'm going to show you the data to back it up. The reason inflation has been sticky is there's two main culprits in the inflation report. Okay, it's auto insurance and it's shelter costs. And I want to break down auto insurance probably more than shelter. Shelter has been broken down quite a bit, and we all know how that is. But those are the two culprits that's keeping this number higher than expected. So I want to show you this chart. This is pretty remarkable that motor vehicle insurance, and for those of you that have had any kind of auto insurance renewals lately, you can probably attest to this. I've just gone through this, and yeah, it's pretty remarkable. But auto insurance increases are up 22% from a year ago. That's a pretty big number. Now, why is that the case? Well, think of it this way. Auto insurance is kind of the last domino to fall. Okay? When you think of inflationary, well, first you had cars, and price of cars spike up. Then the price of parts spikes up. Okay? Then all these costs eventually filter through, and the auto insurance is the last to catch up. So really, this is not demonstrating that there's a fearful head at the beginning of the snake. It's really the tail of the snake that we're waiting on to come down. Okay? So if you look at auto insurance and shelter as a part of the latest CPI report, okay, I know this is a lot of numbers, but here's the simplified piece. So this number right here, 3.8%, that was the annualized inflation number in March. Okay? Of that number, okay, shelter and auto insurance represents 1.87 of that. So in other words, if you were to take these two out, if they were 0 or even just a moderated number, if they were 0, you'd get 2.9% inflation. So that's a pretty significant part. And if you look at all the other parts of inflation, okay, household operations, auto maintenance, repair, internet, I mean, all the way down the list, you see how those are all pretty much in line. So here's the cliff notes on inflation. I really believe we're at the tail end, and there's a couple small pieces that are hanging up this report. The inflation number, that 3.8% that was higher than expected, when you dig at it, it's not that all across the board inflation is higher. It's these two little sticky numbers. So I think that's important to note. So again, there's core CPI. Okay, that's all the numbers together and where that has been over time. But if you strip out shelter and auto insurance, you can see that it came down substantially and has actually been pretty moderate since July of last year. So if we can get these two sticky points, I think you're going to see a pretty big movement in the inflation numbers. Again, the inflation domino has to fall before the Fed interest rate domino can start falling. Now there's a Fed decision tomorrow. More than likely they're going to keep rates steady. We don't expect that they're going to lower interest rates. But remember, there has been this this fear in the marketplace that when the Fed cuts, are they going to cut too late? Or you know, what does the Fed cutting cycle really mean for the markets? Well, let's look at history again. On average, okay, when you look at, this is the point where the Fed starts cutting interest rates. On average, long term, that the market and the economy tends to absorb that. There is a risk of a hard landing, but frankly, given the way economic data is right now, we still don't think that there's going to be any type of recession in the near term. Okay, now, one of the big ones that's on everyone's mind, geopolitical tensions. These are just a snapshot of some articles. I mean, the thing that strikes me is that you have to remember news outlets and the media are in the business of selling advertising. To sell advertising, they need viewership or readership. To get readership or viewership, what sells more than anything else? Fear. So typically, when you see these types of headlines, they're very fear-based. Bold letters, very harsh wording that's used, and it's meant to stoke fear to get you to click or to get you to read or to get you to watch. Having done this quite a while now, I don't ever minimize not only the human toll that goes on with war and tensions like this, but also the potential risk that it does expose. However, I think we have to always look through a very balanced lens as to, particularly in our case, what does this mean for your retirement, for your assets, and everything that we're managing. So if we look at what's going on right now, okay, the first thing that most people will fear is, particularly when you mention the Middle East having a crisis, is oil prices. And what's going to happen with oil prices, and how much of a drag is that going to be on economic growth if oil prices spike? Well, right now, at least, there has not been a dramatic change in oil prices. You got to remember, this Israeli conflict didn't begin a couple weeks ago. It began in October of last year. And so if you look at kind of where oil prices have been, we're in line. They remain relatively low relative to 2022 levels. So that's the first thing. The second thing that I wanted to point out in this chart is I want you to remind yourself back in early 2022, whenever it was, when Russia invaded Ukraine. And remember the headlines that you were seeing, the forecasts that you were hearing, particularly as it related to oil. And you see that at that point, yeah, there was a huge spike in oil prices. And I remember seeing articles, and I could pull these up, and we can all find them online, projections of $200 barrels of oil, $250 barrels of oil, because we were at the point of this maximum fear on what this meant when Russia was invading Ukraine, is Poland next, et cetera, et cetera. Like happens most of the time, all of those fears are exacerbated. And what happened to oil prices really since that point? They've dropped dramatically. So the fears that were projected at the point of that geopolitical tension never came true. Okay. Again, you have to look at each one individually, and I'm not minimizing any of them. But here's another thing that helps make this point. What tends to happen after points of geopolitical crisis? Well, here's a list of a lot of them dating back to 1940. And you can read through these. You've got Pearl Harbor, you've got the Korean War, JFK was assassinated, you got the Iranian hostage crisis, you got the Beirut bombing. Yeah, they're all listed here. And for those that were alive in those periods, right? I wasn't alive in a lot of this. The same held true. What does this mean? Is the U.S. going to get dragged into a conflict? What does this mean? Is this another world war starting? Our oil prices are going to get out of control? What is this? those fears always happen at points of geopolitical tension. But what is remarkable is I want you to look at each of these columns. So this is what is the S&P 500, essentially the broad stock market index. What happens to it at points after the beginning of those conflicts? Well, 1 week later, sure, there's a lot of losses in some of these, okay, but the average is a loss of 0.8%. And 41% of the time, a week later, the market has been positive. I want you to think about that. A week after a large-scale kind of international crisis, geopolitical crisis that begins, 40% of the time the market was still higher. To me, that blows me away when I think about that. When you look at 1 month later, 66% of the time there was a positive market 1 month after the beginning of a crisis. 3 months, 62% of the time, the market's higher. 6 months, 69%. And then 1 year later, 83% of the time, in all of these various geopolitical crises, the market has been higher. If I gave you an 83% probability of winning something, you'd probably think that's pretty good odds, okay? Statistically, based on history, this crisis, 1 year later, there's an 83% chance, statistically, that the market's going to be higher than where it started at the beginning of the crisis. So again, that is nothing to derail the actual events themselves, the human toll that's taking place, but you have to make decisions with, your wealth, your retirement. We have to base them on sound principle. And that's why, in our view, yes, we don't know what's going to happen in this conflict and how much it may escalate, but we still feel pretty good that it should not change or dictate any of our investment decisions based upon that alone. And then this is just a secondary chart showing essentially the same type of information. All right, now here's something to be mindful of. And let me pause and say, everything I just shared in our view, yes, we're still constructive, but it could be choppy. And I don't discount that at all. We could be sideways, some ups and downs, some choppiness, even some more, retracement and markets going down a little bit further from here. Some of this may be seasonal. So if you've ever heard the old saying, sell in May and go away, this is the data to back it up, is that when you look at the average 6-month return from different points in the year, May is the worst point statistically, okay? So the average percentage change is 1.7% rate of return, and it's only higher 64% of the time, whereas the best seasonal period, November, is November to April, which is always an interesting thing to look at. I'm going to keep bringing this chart up until you're sick of it, and some of you might be already, but this is the cycle of how markets work. We go through these periods of optimism, excitement, thrill, euphoria, right? And that usually marks peaks. Market peaks tend to be euphoric. And then we have a sliding scale down. Now, if we look at this, October 2022, we were here. That was the low in this most recent cycle. And I mean, I remember I went back and looked at some of the data and some of our notes from October to January of 2023. People were very, very, very negative and pessimistic. I think I have a couple charts in here just to back that up, remembering where we were. But throughout the last year and a half, we've been climbing this cycle. Okay. So the point, or the question that I guess I would ask you, and the question we're always asking ourselves is, what point of this cycle are we? There are some that will tell you that we're at euphoria, that going into April of this year, we were at euphoria. I don't quite believe that, but maybe. Candidly, I think we were somewhere around this optimism phase. And so optimism, excitement, we're kind of in this point in the most recent bull market. But what happens is you get these corrections, you get these market events like we're going through now. And so someone who might be here gets bumped down. And so the general cycle of emotions is not just you hit the next step, then you go to the next step. No, it's kind of this 2 steps forward, 1 step back, 2 forward, 2 back, right? You constantly are climbing this cycle. Eventually, we'll get to euphoria again. I thought this was incredibly interesting. You have to separate how you are feeling from how you invest. And this is going back to 2000, so the last 24 years, looking at a Gallup poll at what percent of Americans were satisfied with how things were going in the US. So there's a lot of amazing things about this chart that I won't even go into, but for example, back in 2002, almost 70% of people were satisfied with the way things were going. That's pretty remarkable, in my opinion. Okay? But look at what has happened since 2009. 2009, if you remember, right? We had seen 2008, 2009, the great financial crisis, subprime lending, markets going down 50%. I mean, it was economic calamity, really. And since that time, we have remained in a state of pessimism. Only, between 10 and 30% are satisfied with the way things are going. Now, maybe there's a ton of reasons as to why people are answering this, and it's not for us today to figure out why. But what's remarkable is that in all of this pessimism, you've had one of the greatest advancements in the market's history. So throughout this period of pessimism, the market has had incredible returns. This is 2009 to today. Of course, you had bumps along the way. We all know that. So the point being is, don't allow how you're feeling about, man, things are just, they're crazy right now. This political environment's crazy. The economic environment's crazy. Whatever your political persuasion is, whatever your cultural persuasions are, whatever it might be, I firmly believe you have to segment that from your investment and your expectations on money and your wealth. All right, some of these last ones I'm going to go through just real quick to kind of give you an update where we are. This is a chart I showed in our January outlook, and it was illustrating that literally the amount of pessimism or fear was in October of 2022 worse than the great financial crisis. This blew me away. And this is one of many, but one of the reasons that I felt very confident that, man, we are near a bottom, and that it's probably a good time to put money to work in the market. So where are we at today? Well, we've definitely improved. And the sentiment has become much more bullish than it was then. Now that should make sense, but here's something to think about. Isn't it interesting that people get bullish or they feel better about the market after the market goes up? Shouldn't it be that people see the opportunity when markets are really low and think, man, I should really be buying. It's human nature. It's difficult. It's emotional, I know. But as the markets climb, people get bullish and they feel better. And that's what we're seeing today. Is it at a point where there's too extreme of bullishness? Well, I don't think so. Here's one reason. Because even though the market has gone up for the past, 18 months, okay, short interest has gone up. Let me explain what that means. Someone who is short the market is essentially taking a bet that the market's going to go down. So if, as you see this line going up, that means that people believe at a greater extent, people are placing money, bets that the market's going down. So this whole time, that short amount of interest has gone up. So that's also an indicator that I don't think we're at the end. Cash. Let's talk about that. One of the criteria that I gave you at the beginning of the year was that there was so much cash on the sidelines. Now, a lot of that has come off the sidelines throughout the last 4 months, 5 months. Okay, and that's what this chart is showing. But this is where we started. Remember I said that throughout the period of 2022 and 23, when the markets were really good, okay? So markets are really good, but people were coming out of the market at the same time. And so cash balances, okay, reached 1.1 trillion. So what this means is there's still a long way to go. Still a lot of cash, there's still a lot of buying left that is likely to happen in the markets. Okay, I mentioned there's an AI super cycle taking place. A lot of people have been asking, man, all right, are those stocks in a bubble? And I mean, I can see why you're asking that. Here's some of the returns of some of those stocks. Just, I think the last year. Okay, and there's others that are up, 100%, 150%. So, are they in a bubble? Well, let's start with the premise of why we feel this is a super cycle. Again, the chart I showed you earlier on. There have been these waves and these periods of technology super cycles, mainframe, PC, networking, internet, etc. And we are still, from a time perspective, still very early on in the AI cycle. Now, in any bull market, things can get ahead of themselves and things can pull back and kind of flush out some of that excesses. That doesn't mean it's over. It just means it's kind of that 4 steps forward, 2 steps back kind of thing. In the Bank of America Global Manager Survey, these are fund managers, these are institutional people that they're asking questions to. They were asked, do you think that AI stocks are in a bubble? And this is the response. 40% said yes, 45% said no, 15% said they didn't know. So let me tell you, having seen a lot of bubbles over the years, okay, and think back to maybe some others, the point that you're in a true bubble is when no one believes it's in a bubble. Think back to real estate in 2007. And for those that maybe not remember, I mean, you literally, people were explaining that real estate is the new safe asset. It won't go down. Like, you can't lose in real estate. There's radio commercials popping up about investing in real estate. It's all over, like everyone is doing it. Borrowing 110% of the value of real estate to buy more. When people feel bulletproof about an investment, that's usually when you're in a bubble. And the fact that you have a pretty split level of institutional investors saying, yeah, I think we are, no, I don't think we are, I think that's pretty conclusive that we're probably not yet. So going back to this super cycle idea where we're in the early stages and we're not at the point where people just feel euphoric about it yet. even though there's been a lot of incredible returns that have already happened. I get that. All right, so I'm going to wrap it all up here. What is kind of, this again is going back to our 2024 outlook. Has the tide changed? Let's look at the scorecard of kind of where we are. The first thing, lower interest rates. We thought that in the first half of the year, interest rates were going to start going down, and then later in the year, turn higher again, potentially. Well, that's been delayed. That has not been correct yet. I still think that the direction of interest rates is down, but that inflation number, the Fed can't start moving until it feels that it sees what they need out of the inflation data. The second, stocks go higher in a bull market. That's been true, and I do believe that will continue. Nothing has caused me to change that view. We felt that there's no bubble in the market in sight. I still do believe that. I don't think that has changed at all. I think we're going through a correction. I think there could be some choppiness, maybe for a few months, right? But I don't think that there's the end of the bubble. Now, election year trends favor stocks. So in January, we kind of broke down what the election year looked like. And the conclusion was that based upon the type of election and the type of makeup of both the presidential and congressional and Republicans, et cetera, that has proven true so far, but we still have an election to go through. But I do believe, again, that trend and the reason behind that still remains. The fifth, large amounts of cash on the sidelines helps the bullish case. Well, that's been true. And I showed you how cash has been coming into the market. So cash levels are coming down. The amount of cash allocation that investors are using is coming down, meaning they're putting money into stocks. But there still is a lot of cash on the sidelines to continue to help that case. And then lastly, the AI supercycle underway. That was another bullish case given in January. And again, I feel that is still remains. So what should you do? Here's what you should do. You have to remember that investments, it all ties back to planning. If you have not created a sound plan, then you can't really invest properly. And so those of you who are clients, you've seen this before, you hear us probably talk about it all the time, is that if we've sat down and worked through a plan, have confidence in that plan. The things you're going to hear on the media, in the news, it's going to make you think a lot of things, you're going to hear a lot of things, but revert back to that foundation is that plan, okay? If you don't have a long-term plan, if you are not a client or you're just kind of listening to this and you're more investment focused, you can't invest without having some type of plan, because you'll get tossed by every current and every wave of current event that happens, and you'll be all over the place and not be able to be disciplined or consistent in any way. So that's what you should be doing right now, is really kind of digging into that plan and having confidence in it. All right, so a couple upcoming things and we'll wrap up. A replay of this will be available on our YouTube channel. You can just Google us, you should find it. You can subscribe. It will also be available on our website at our Insights page. And we're also hopefully going to be able to get it blasted out via email here shortly as well. And the other thing I'll mention is this Friday is our annual Clays to Raise fundraiser benefiting the Raleigh Dream Center. There's still spots available. We'd love you have you come join us. It's always really a phenomenal time. If you've never shot a gun before, don't be intimidated. We have people every year that come that have never shot a gun before, and we go and we break sporting clays. It's a ton of fun. Everybody comes, has a ton of fun. So there's still spots left. email us. We'll make sure you get the right link to register and go from there. So thank you very much. I appreciate the opportunity to share with all of you. If you have questions, reach out to us. And look, it's only 40 minutes in, so that was much better than maybe an hour. But thanks a lot and have a great day.